Scott Bessent recently called the U.S. Markets anti-fragile, and I would really disagree with that. There's two certainties in life, death and taxes, but I think we have to add a third, which is just ongoing and extremely large auctions of U.S. Treasuries. The world is awash of them, and there's no obvious solution at hand. And I do think, Tom, market prices are kind of blaring here and telling us something. And the thing about market prices is they're both a response. They react to what investors do, but they also create risk. And I think with respect to the back end of the bond market, now we're above 5% on the 30-year. We're doing this amidst a lot of discussion about a Fed easing cycle, right? Treasury bond yields were rising in 2022, but that was a tightening cycle. The Fed was well behind the curve, and you knew the short rate was going up quite a bit, and the long end followed. Here you have, if you look at the Bloomberg WIRP page, you'll see the market's handicapping easing, but the back end is its own thing right now. There's a risk premium there, and I think we're coming out of this tariff uncertainty. The downgrade doesn't feel good. And so I think that, to me, becomes one of the bigger risks for the stock market is, frankly, the bond market itself.
So talk to us about the state of the bond market, because we saw it kind of freeze up in April, and we got some of that around Liberation Day, really unusual trading there that you don't normally associate with the U.S. Treasury market. What does that tell you?
Right. So if we look at that chaos from April 2nd, Liberation Day, to April 9th, which is the Nevermind Day, where Trump basically undid those 5 days of big risk off, you had a rising VIX into the 50s, got as high as almost 60 intraday, and rising Treasury yields. That's not a combination you see very often. And, I think over time, as John was referencing, this gigantic supply of treasuries has sort of reduced the risk-offness, meaning the ability for the treasury market to serve as a flight to safety asset. Right. It's no longer doing that. So I think that's what we have to appreciate. I think it's very difficult not to continue to be invested. I do think, having a little bit more cash on hand makes more sense. Having these other alternative assets like Bitcoin and gold, I think, makes sense. And then, again, I'm speaking my own book here because I specialize in hedging and volatility, but investors have got to understand how to use things like options, because when you have the potential for the bond market to misbehave as it appears to be doing, that could spell disruption for the stock market.
So how do you think about, again, we've got the VIX here, still below 20, 19 and change here. Is that a healthy level of volatility in the equity markets? Is that something that we should be concerned about?
I think it's I think that's right about the long-term average. It's right around 20. And of course, you've had these periods of 10. You had an 80 in the GFC, an 80 in COVID. You're coming off something that was very high, and this was a very interesting risk event because it was created by Trump and then undone by Trump. I think the tariffs are a little bit less of a risk now. I'm a little more concerned about the bond market. Paul, I think the question is the cost of hedging a good deal? And I think it's pretty fair. Markets, to sustain a 20 VIX, you need the market to move around at kind of a % a day, which we got today. And, that, to me, that's a couple of small moves and then one big move every 2 weeks or so.